Hi, let us come back to our course on the financial frauds, how to detect and prevent it. Before we go deeper into understanding how the financial frauds are done, let us understand about the conceptual framework of financial reporting. Now, the conceptual framework of financial reporting have three assumptions. So it works on assumptions, principles, and also some constraints. And then it has a qualitative characteristics. Let's look at about the assumptions first. The assumptions of the financial statement that we have here is that the accounts are prepared based on the economic entity of the company. So it is treated as an economic entity. Is not necessarily only a legal entity, but also an economic entity. Let's say there is a company which is separate by legal matters, but it owns another company, which is an integral part of the main company. So the financial statements require consolidation so that we can understand the complete picture of the financial statements, not just only the one portion. So there are standards which are defining what is the meaning of a economic entity. Then you have a second assumption as a going concern, which is a major concern for a lot of investors and creditors, that the company that they are looking at the financial statements, or the investor, or they are going to invest, will be able to survive in the next years or coming years or not. Auditors are required to demonstrate, to check that the company has a going concern, the company is solvent, there is no risk to the company's business. If the auditors feel that the company may not be able to carry out its activity beyond a year or two, they have to highlight it. The management has to demonstrate or has to certify that the company has no existential threat in the near future. So the auditors usually see the product lines, how they have been doing, are the company doing anything on innovations, the sales has been dropping or not. Um, the revenues are consistent, the assets are not obsolete, the collections are collectible, they are not gone, the company will be able to pay the liabilities in the time in the future, and they will not go bankrupt. If the auditor feels that the company will not be able to survive the business, and so may not be able to work as a going concern, there are certain different set of accounting principles that need to be applied for presenting the financial results for those companies. So it's a responsibility of auditors and also the management to produce, to prove or to make sure that the company is able to run its business. Sometimes the fraud happens here when the management is not disclosing enough information to auditors to be able to judge that the company will be able to continue the business or will not be able to continue the business. For example, huge litigations that are ongoing. Auditors, if unless they are explained by the management, will have maybe not that much of evidence to find out is there any existential threats to the company. Maybe they have breached any copyright, they have any patents, or maybe they have not filed any patents. Another company has already filed a patent for the main product that the company is already been producing. So there is not much of evidence that the auditors will be able to come up with. So it depends on the management information. Mostly auditors rely on the management information for these kind of things. So there is definitely a chance for the senior management to hide the information. Then the another frame and assumption is that all the monetary units and are being considered. We are following all the transactions which are having a monetary value. The transactions which does not have a monetary value are not being reflected in the financial statements. It may be the goodwill, the talent of the peoples, the other aspects of the business which are not reported in the financial statement. And you have periodicity, means they are the financial statements are being produced every year or every 3 months or every 6 months, and the periodicity is continuous. So it's not like you are producing monthly statements and then next year you start producing quarterly and then next statement go back to monthly. You should have a consistent way of producing the financial statements so that the information is consistent. Then you have the principles. There are certain principles which are followed by the accounting standards or the in the financial reporting, and they present the opportunities for the management to produce to commit the financial fraud. Those ones can be as historical cost. Every in the most of the balance sheets, assets, liabilities, equity, they're all produced at historical cost or sometimes at fair value, but it does may not reflect the real economic value of the assets. Now, if let's say, for example, there is a building there and the management and the building has worth $1 million when they were purchased, or in the current times the building may have no value, or in the current times the building may be $100 million value. If it has $100 million value and the management has not been doing any fair valuation, or they are because they are not forced to do by the accounting standards, and the auditors cannot certify that there is 100 million and you have no idea about that, right? But if it's worth only $1 million and it's sold as asset, fixed asset, not as a property for investment, the company will, and is for generally for internal use, the auditors will not be able to force the absolute value or the impairment, because impairment is generally for cash generating units, not for the things which are hold for the internal consumptions. So the maybe the assets that the company holds no value in the market, but they are still being carried at the high values, which may give the false presentation. But if the management knows that the value has already been reduced and there is no way the value will be increasing, so it's job of the management to write down the value of the assets so that the investors or the users of the financial statements understand it clearly. Then there is the revenue recognition. Revenue recognition is governed by the international accounting standards, by the IFRS, by the US GAAPs, and the main principle is whenever the economic benefits has been transferred to the customer, the sale has been done and revenue need to be recognized, not before, not after. So there are many ways where this revenue recognition principle is manipulated to either inflate the sales or to deflate it. We will be learning that in more details. Then you have matching principle, matching expenses to the revenue. There is a lot of chances that are happening, which where the management can divert the expenses. Maybe they are not showing the expenses in this year, but in next year. So this year profitability will increase, next year profitability will decrease, because you are not following the matching principle. So it can distort the profitability of the company by just moving the expenses to the next year or the next period, or moving them from the operating expenses to the capital assets. Means you are interpreting the accounting principles in a wrong manner. Then you have the full disclosure. Means you have to have material transactions closed completely, not partly, so that the users of the financial statements understand them very well. Certain constraints in the preparation of financial reports are that it has a cost and benefit. Means there are certain valuation, there are certain things, estimates that cost a lot of money to the company, and there is little benefit for the management to produce it, or the little benefit for the users to have a material impact on the financial reporting. So those kind of disclosures or efforts are not taken by the management, and to have a cost benefit here, again there's a judgment then the management has to make in order to really say, okay, the disclosures we should be doing or we should not be doing. Materiality concept again is a very important one, where the management may feel some transactions to be material enough or non-material enough to be disclosed. while the auditors may have different set of materiality, users may have different set of materiality. So it's because materiality has no standard to it. There's no there's no benchmark of the materiality will be 5% or more, 1% or more, 3% or more. There's no benchmark for that. Then you have industry practices. So there are certain industry practices, for example, hospitality. We have a special principle to produce the financial statements